Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting. Welcome to Market Minutes for July 20th, 2020. Please see our disclaimer for important information. So in our market meetings this week, we've got a lot of information to cover. We're beginning to get some information from companies that are reporting their second quarter earnings. We've got some information on the high frequency data that we've talked about in the past. And we've also got some other things on the margin, perhaps related to the labor economy, that I thought would be helpful to cover. Certainly want and suggest all of you to take a look at our Charts of the Week package that also comes out on a weekly basis, and that has some interesting charts related to some of what we're talking about here today. So with that, we'll get into the meat of the data here. So for the last week, the S&P 500 was up 1.2%. The Dow Jones was up 2.3%. NASDAQ took a bit of a breather. It's been a strong leader, up 17% year to date, whereas the other indices are down. NASDAQ was actually down 1.1% of the week. For the week, so for the year, the strength in the equity markets over the last several weeks has really kind of brought the S&P almost to a flat line. It's barely negative for the year. The Dow is still negative 6.5% for the year. International stocks, as defined by the MSCI EPA index, down about 9%, and then Barclays aggregate bond index is up about 7%, and then both high yield and leveraged loans are down anywhere between roughly 1.6 and 3.4% for the year. But stocks rose for the third consecutive week, bringing the S&P 500 basically to within more or less about 4.5% of an all-time high. And so, we saw this shift out of technology and some of the leadership that we've seen. We saw some earnings reports from people like Netflix that had less subscribers than expected, and so that kind of shifted some of this market leadership to more cyclical areas of the economy. And small caps performed a little bit better, and we heard from quite a few banks, and so I'm going to talk about that in a minute. So that's something that we definitely want to keep an eye on, because the banks are foreshadowing in many respects what they believe is going to be a less enthusiastic environment going ahead. So with regard to fixed income, I talked about basically the performance of the aggregate index for the year, and that's on top of being up almost 9% last year. That's certainly not representative of all bonds, though. But high yield had another good week. And spreads remain fairly narrow in an environment where we have really low aggregate yields. The 10-year Treasury is kind of hovering around 0.6%, and the three-month LIBOR is down to less than 0.3%. Obviously, the Fed funds target rate is roughly 0, and even the 30-year Treasury is only 1.3%. And so that's had a downward effect on a lot of different benchmark rates, including mortgages. And we'll probably have a little bit more on that in the chart pack for next week. But suffice it to say, those rates are really compressed right now. Data for the month remains mostly upbeat. We're getting data for June right now. What we're seeing is that with the surge in cases and some of the new restrictions being put in place on some of the economies, primarily in the Sun Belt states and some other states as well, could actually cause a pause or deceleration in the data for July that we're going to get next month. But having said that, the retail sales, the control group, as they say, that gets included in GDP actually rose a little bit more than 5.5%, and that was exceptional. And I refer you to the chart pack for a couple of charts on retail sales and how they really bounced back. But then there's speculation that spending has been, kind of supported by the CARES Act payments, and some of that stimulus is going to run out at the end of this month, and then, also against the backdrop of perhaps some curtailment in some consumer activity related to some of these new restrictions that are driven by the rise in coronavirus cases. So, something on the margin too that we're seeing that we're going to have to pay some continued attention to is the fact that consumer sentiment was below expectation. Again, it's not what consumers say they're going to do, it's what they actually do. But suffice it to say, having consumers begin to say, at least in survey terms, that they're not going to be as active is something that we definitely need to pay attention to, with consumer spending being more than 2/3 of the economy. Have a little bit of information on high frequency data. So, we always look at the TSA checkpoint data, and I think we're going to perhaps see some mitigation in some of this data as with the rise in some of these cases. But at least for the last week, TSA checkpoint counts were up about 9%, even though they're down about 77% year over year. But for the month, they're up basically 100%. So they've doubled in the last month. So we've got more people running through airports. Hotel revenue per available room was up 9% over last week, and up 41% over the last month, even though they're still down 60% year over year. Hotel occupancy up 2% for the week, 8.5% for the month. Steel production, we've got up 1.3% for the week. Rail car traffic was up about 0.5%, and both of those are positive in the month over month. So, staffing looked like it was up. Really the only thing that we saw that was down for the week was the Open Table, which is a dining reservation app, is kind of an index for the activity in the restaurant sector. And we know that some of the restaurants in some of the high-risk states have gone from, say, 75% to 50% capacity. Over the last week, that activity was down 3.1%, although over the last month it's still up about 18%, but still down 65% year over year. So a little bit of update on the high frequency data. We've got, we're going to have to watch what happens to technology, because that's we're beginning to see like a little small shift in the breadth of the market. And as I mentioned, it's been very narrow, and the techs have led. People still go to tech for safety. And with this consumer sentiment having changed, we're going to have to watch its effect on the various sectors. But we've had a very euphoric environment. IPOs, from Sandy Leeds' notes for the week, 7 IPOs have more than doubled on the first day of trading during this pandemic, which is really kind of interesting when you think about it. But the next thing I want to talk about is we're getting some information from banks, and the 6 biggest banks have added about $36 billion to their loan loss reserves, which is a charge that they take for anticipated losses, and that number fluctuates as the economy does. And so, the message that we're hearing out of this is that they don't feel that that the recession is really taking root right now. Even though we saw it in the rearview mirror, a lot of people feel that we're in the process of kind of working our way out of the recession. But what the banks are saying, not just by the loan loss reserves, but in what their comments are, coming out of these earnings reports, that feel like basically a lot of the crux to this has been delayed by the CARES Act. So they're a little bit more concerned about what happens to us down the road. And, the general consensus is that we're going to be, negative in the third quarter, and we know it's certainly going to be negative in the second quarter. And we'll get the second quarter GDP data actually next week, at least the first reading. And then the fourth quarter is going to be positive, and then we're looking for more positive performance next year. But the banks are certainly adding liquidity and taking charges against future loan losses. So that's a little bit of update there. The Federal Reserve's financial stability report for May basically suggested that non-financial business sector, which already started off at pretty high historical levels of debt, that now we've already seen $800 billion in downgrades of investment grade debt and $55 billion in corporate defaults. And it points you to the chart pack for this week for some charts on downgrades and corporate defaults and bankruptcies. Now, and that was actually a faster pace than what we saw in the global financial crisis. And so, with the stress that we've seen from higher corporate debt levels, which we were talking about at the beginning of this year before COVID even was, people knew how to pronounce it. We've got default probabilities and expectations for credit, stresses going up as we go along. And so, clearly those are some of the steps, like within our own portfolios, that we've been kind of taking to try to mitigate the impact of potential credit defaults. So that's that. We heard from the IMF, the International Monetary Fund. They now estimated that real global GDP, basically the global economy, dropped at an annualized rate of 18% in the second quarter, after roughly a 13% drop in the first quarter. And they're still citing some of the things that we're watching. The U.S. and China tension, the impact of U.S. elections on and coronavirus cases on spending activity, because the U.S. is obviously the largest economy in the world on a standalone basis, and consumers in our country account for 70% of that. So that's very important. And also they highlight the risk in emerging markets. So we have taken steps also to kind of mitigate some of our international risk in some portfolios as well. But getting back domestically, so the Federal Reserve and the Federal Open Market Committee, the key takeaway from some of these latest deliberations and some of the speeches that you're hearing from some of the Fed presidents that are also voting members of the Federal Open Market Committee is that they're almost aligned in the thinking that if the healing of the job market is going to take a long time. In economic activity, we're going to see the noticeable decline, and that employment itself is not going to reach its maximum level until perhaps even 2022, maybe even towards the end of that year and into 2023. So that has profound implications as the Fed kind of transitions from a role of being more of a market stabilizer, if you will, to really being one that's designed to provide more accommodations to their dual mandate of price stability and full employment. So we know that that as they do this pivot, that they're going to be acutely concerned with the labor markets as it relates to the desire to achieve full employment. So I think we should probably certainly pay attention to this forward guidance. But I think, having said that, what it really does is continue to reinforce this notion that rates are going to be low, and continue, at least in another vein, to kind of assume that the Fed's going to be willing to accept a little bit of inflation, and perhaps even a slight overheat, when demand comes back in earnest, when all these restrictions are lifted, when we have a vaccine in place and the economy opens up fully. I think you could see the inflation to offset the disinflationary pressures that we're seeing right at the moment. But I think that, so a couple of read-throughs on all of this commentary that we're hearing from the Fed. One, that you're going to see rates continue to be low for longer. Two, that you're going to see the Fed be open-minded to the notion of letting inflation run a little bit more. So that's another thing that in portfolios, I think we're beginning to consider. We're considering this notion of inflation protection, not for today, not for tomorrow, but really more for next year and the year beyond. And I think we're going to have to continue to really focus on the importance of their forward guidance. So deficit numbers, The government deficit for the month of June alone was 864 billion, which is a record. The forecast for this year is over 3.7 trillion deficit, but it could be as high as 5 trillion. We don't know. We had 2.2 trillion in the CARES Act, but we know that we've got more stimulus somewhere on the offing. Looks like the legislators are getting back to Washington for the time that they have before their eventual recess. That we're going to have, actually more stimulus that could pad that number. I mean, this is historic deficits that we're talking about. We were already going to have a $1 trillion deficit even before the pandemic. And it's interesting, if you go back to the global financial crisis, we were running $1 trillion deficit for basically 4 years coming out of that. And so, I mean, that pales in comparison with the environment that we see right now. As we move into the fall, we're going to continue to see uncertainty due to the pandemic. We're going to have, perhaps rolling flare-ups. And this, I'm kind of looking at some of the notes that Sandy Leeds put together for the last week, and I think they're really spot on with the outlook for spending and credit. He talks about the second wave could reignite the financial market volatility. I totally agree with that. And already we're seeing some changes in the attitudes on lenders. So credit standards for borrowers is getting a little tighter, and then obviously incomes, incomes become impaired because of stimulus removal, and people are not necessarily spending. We know this from the consumer sentiment numbers dropping off. If they don't spend, whether or not they're making the money or not, it's still going to impair our growth for a little bit. But in any case, just talking about the labor market for a few minutes, the job gains that we saw over the last 2 months were really kind of focused on workers that were on temporary layoff. And so we saw a lot of gains. A lot of the gains that we've been celebrating have been in the kind of the leisure and the hospitality sector and some of these lower wage positions that, while it's good to see people back and working, it was in that cohort that we saw most of the gains. And so there's perhaps a feeling that maybe we have seen the biggest gains for now, and that the gains are going to be harder to come by going forward. So we'll have to watch that. And initial claims for unemployment insurance have moved kind of sideways, so we just don't know, especially with this resurgence in caseloads, whether we're going to whether the progress that we've had in labor is going to be really sustainable. So we're going to have to watch that as well. And the other thing, which is an article in Barron's that I read over the weekend, which is really interesting, is just, this whole notion of getting back to work and people working remotely and how that impacts working people with families, with kids at home, if we're not in school, and what the impact of that is. That basically this article says 1 in 5 workers rely on daycare centers to basically allow them to be able to work. And so, if you don't have child care for somebody, that creates really a pretty big disincentive. $600 a month in extra unemployment coverage is really not an issue. The bigger issue for roughly the 40 million children that are in pre-K through 8th grade in the U.S. And you've got parents with kids that make up basically a third of the workforce. That this is this dislocation is really tangible. And the article also talks about the issues of people that, because of the lack of daycare and things like that, are out of the workforce, and then it's tougher competition-wise for them to re-enter the workforce. So they make the case that that this decision around school openings and how we're going to send kids, how we're going to educate kids is not only going to impact the kids in the social interactions and in perhaps the quality of their education, but also affect, basically the labor market for at least the next 5 years. So if you have a chance to read Barron's from last week, that would be one thing that I would suggest that you pay attention to. But in any case, that's just a little bit of information for you. I certainly have more, but I hope you've enjoyed this segment of Market Minutes. Please see our information here on the screen, our contact information, and please, we welcome your comments, suggestions, and feedback. And as always, we enjoy having you with us and appreciate you taking the time to listen, and I hope you have a wonderful and safe week. We'll talk to you next week.